Time now for hot picks. The consumer staples sector has been lagging behind the S&P 500 over the past year or so. But our next guest says after last year's underperformance, he sees valuations looking more attractive, particularly for quality names. Let's bring in Filippo Falorni, director and lead analyst of U.S. beverages, household products, and personal care at Citi. Filippo, good to see you, sir. Thank you.
Hi, Mark. Thanks for having me on, and Happy New Year.
Happy New Year to you as well. Now, before we get to your picks here, I'm just curious about staples in general. We know that the U.S. 10-year is up around 470, the 30 years moving towards 5%. Not always a great situation for rate-sensitive type companies. So what are the risks to these names in terms of higher yields and inflation ticking up?
Yes, definitely. That's been one of the reasons of the underperformance of the staples sector overall compared to the market. As you mentioned, has been lagging the S&P 500, but over 12 points over the last 12 months. One of the key concerns has been the rates, right? Like clearly staples companies are viewed as bond proxies because of the stability of cash flows and dividends throughout the earning cycles. So there's clearly an inverse correlation with yields and valuations. But when you look at what we've already seen in terms of relative valuation of staples compared to the market, we're now trading over one standard deviation below the historical 5-year and 10-year average to the market. So to me, we're getting close to valuation levels which look a little bit too depressed for the staple sectors. And as you mentioned, there are some quality names that you can play for a potential re-rating within the group.
Let's get to those names. Coca-Cola you have as an outperformer. You cite the fact that it usually beats analyst estimates on earnings and raises its estimates as well. So what are your main reasons for liking Coca-Cola?
Yes, absolutely. Coca-Cola is our top pick overall in the space. We think the fundamentals are some of the best in the group. They're growing organic sales, which is a measure of price and volume and mix, by about 5 to 6% very consistently throughout the last couple of years. More recently, they've been even growing well above those rates in the 8 to 10% range. But really, what we like about Coca-Cola is that it's a very balanced top-line growth. They're growing volumes, which is pretty unique in the staples growth, where many companies have been growing top-line mainly on pricing. And on top of that, they're getting price, but also mix in the form of smaller pack sizes. And that really allows them to grow the top line above their peers. Some of the volume growth is also driven by their emerging market business, which is 40% of sales, where we think there's still a lot of runway for them to expand and gain share. And as you mentioned, they've been beating numbers pretty consistently. One of the market concerns has been foreign exchange, given 70% of their sales are outside of the U.S. and the dollar clearly has strengthened. But given the fundamentals in the underlying business, we really think they can offset these incremental effects headwinds, also with pricing in many emerging markets, and deliver solid earnings growth. And the valuation, lastly, it trades like essentially 3 to 4 turns below their peer group, and we think that offers a pretty interesting opportunity from a valuation standpoint.
All right, another hot pick from you is Colgate. Would you call this a classic defensive stock?
Yeah, look, it's a pretty defensive stock. It plays more in the household product and personal care side, in the HPC side. The stock did pretty well in 2024 on a relative basis versus the rest of staples, but it's really pulled back over the last 2 to 3 months around some concern around FX, but also pricing deceleration in some of their emerging market business. What we see at Colgate is that even with this pricing deceleration, we think they can grow at the upper end of most of their household product peers. We think they can grow consistently around 5% organic sales growth. And similarly to Coke, this is one of the names that have the most emerging market exposure. It's about 45% of their sales. And really, they continue to grow both volume and pricing in many of those markets. And on top of that, their pet food business, which is the Hill's business, is 20% of sales. That has significant continued opportunity to gain share and distribution in the United States. So there's really an opportunity both in emerging market and developed markets with their pet food business. And we think the pullback over the last 2 to 3 months offers a compelling opportunity here.
And then lastly here, Filippo, Keurig Dr. Pepper, how much of a big part of its business is our acquisitions and taking small stakes in small companies?
Yes. So they've done a lot of smaller deals recently. The last two ones have been Electrolyte, which is essentially a sport drink brand, which has expanded significantly in the US. And that was more of a stake into the name and a distribution partnership. And then more recently, they've taken the full acquisition of Ghost within the energy drink space. So those deals continue to be a driver for their soft drink business, which is about 60% of the total company. And that business continues to do very well for them. It's been growing 4 to 5% pretty consistently. The area that has been under pressure for the company is the coffee side, which is about 40% of the total company. The U.S. coffee is about 30%. And that part of the business has been more challenged. One, from a volume standpoint, there's been not really a big pullback, reacceleration in volume post the pullback that you saw in 2022 and 2023, because they were cycling very elevated comps during the COVID period as everyone was staying at home and consuming more coffee at home. And then more recently, the other concern has been rising coffee prices on the commodity front. What we like, though, about the business, even in coffee, is that most of their peers have also announced significant price increases on the roast and ground side. So when you think about the coffee pod, the Keurig system, they're not going to have to take pricing up as much as most of their peers.
Right.
And they can offset the cost inflation and still drive top line and earnings growth.